Good morning, everybody. It's August 11th, 2021. We're now approaching the end of summer. School is starting in now or over the next few weeks in most of the country. And even while the resurgence of the pandemic seems to be delaying some of the return to office schedules, it sure looks like this is a market trying to resume normal seasonal buying and selling patterns. So what should we know right now? And what does that mean for 2022? So that's what we're looking at today in this month's Altos Research webinar. Each week, Altos tracks every home for sale in the country, all the pricing, all the changes in pricing, all the supply and demand, and presents the data to you so that you can see it before it becomes available through the traditional data sources and headlines. Before we dive into the data today, some housekeeping things. We have a lot of folks on the call today. We have two people from the Altos team participating with us, Lael and Jeff. They will be in the chat, so use the chat box for questions along the way, for links. So sometimes I'll mention a few opportunities to download or check on some things for yourself. So have that chat window open. You can use that for questions, for clicking through the links or other resources that we share during the conversation today. Jeff and Lael will be monitoring that and following up as quickly as we can. We do record the videos, so if you'd like a recording, keep your eye on your email for after sometime this afternoon or tomorrow. We'll get that out to you, to all folks who are here can see the recording. And always, as always, feel free to reach out and check on if you have specific questions along the way. But I'll try to get to a lot of data today. Okay. Let's dive in here a little bit. Ideas for today. We're going to spend a lot of time, as we always do, looking at the U.S. housing market right now. We've got a ton of data, a lot of the big indicators, but also some of the nuanced things. So like what are some leading indicators that we might look at, keep our eyes on for changes coming this fall? There's a big question on a lot of folks' minds, and a lot of the headlines tend to be around weakness in the housing market. Are there any signs of weakness? Like, are there anything going? And it's really the question of the day, like, is the pandemic boom, is it over? Is it going to finally be opportunities for buyers in the market? And then we will wrap up the conversation, as we usually do, with looks at some of the local data. Different markets, especially some of the markets that have been super hot out there. And are they changing this fall? What do those look like? So we've got all those going underway. That's the agenda for today. Let's dive into the data. Actually, the first thing I always like to point out before we actually look at the data is for professionals. If you are a professional in the real estate market, you're buying and selling, you're an agent, broker, and if you have not yet downloaded our ebook, How to Use Market Data in Your Real Estate Business, I recommend that you do that right now. This talks about a lot of the data that we will look at today and how to interpret it for your local market. How to have the conversation with your clients. So scripts and opportunities, places in the sales cycle to use that discussion, how to use the data. So if you haven't, and you're a professional in real estate, if you haven't already downloaded the data, that market ebook, go to that link right there. We posted the link in the chat, download it so that you can then be as familiar with the content as we are in this webinar right now. Love to see people doing their own webinars, their own videos with their local data. Okay, let's dive into some data. So inventory, available inventory of unsold single-family homes has been the story of the year. The pandemic had us cratering, fewer and fewer homes for sale each week. You can see that this week we have just under 412,000 single-family homes on the market. These are unsold, available on the market. If you walk into the market today, this is what you'd find. You know, very recently, even just a few years ago, we'd have over 1 million homes on the market at any given time. And a decade ago, it was really 1.5 million or closer to 2 million homes that were on the market. Each year, fewer and fewer homes are available for sale because more and more Americans are keeping a second home when they buy, trade up or trade down. They keep one for investment properties. And they can do that because interest rates have been so low that it's really affordable to hold 2 mortgages and keep one for an investment property. And as a result, each year there's been fewer and fewer homes for sale. That accelerated this year as mortgage rates fell below 3%. And it hit its peak of the year. The peak of the frenzy was at the last week of April 30th this year. We had only 307,000 homes on the market. Inventory has been climbing every week since April 30th. Normally the low point of the year is January 1st or the first week of January. And then by second week of January, a few more come available. By then third week, fourth week, et cetera, we start climbing. Inventory usually peaks next week, August 16th. A lot of times I've seen a lot of questions these days, especially the last few weeks about from consumers who are not used to looking at the data. And they're asking, why is inventory climbing? And really the underlying question is inventory climbing because the market's cooling and suddenly we've got a new dynamic happening? Like all of a sudden, is it going to be buyer opportunity? But really the quick answer, the fast answer to that is inventory is climbing because it's August. And that's what inventory does in August. What happens is we start heading back to school, slightly fewer transactions happening. In the last of the summer, inventory gets listed. So inventory keeps climbing up, usually till the second week of August before it starts declining. So we probably have one more week at least one more week of inventory, but then we'll start seeing inventory decline, pulling back through September, October, and then of course the holidays, we have the fewest homes on the market to reset in January. So last year at this time, that was the unusual, the crazy part, where inventory was still falling because demand stayed elevated into August, September, October, November of last year, because we didn't have any of the seasonal change. We didn't have schools in session. We didn't have work schedules that were driving our normal seasonal patterns. So we've reset at this new level of active inventory. More people have bought 2 homes last year, took inventory out of the cycle. So what we can expect for the next few weeks is likely a peak maybe next week, maybe a little extended because homes have been moving so fast that we could still list a little bit later into August, maybe September, but really it's likely to peak next week and then start ticking down. That should answer most of the consumer questions, but really when consumers ask you, why is inventory climbing? The answer is it's climbing because it's August. So that's where we are, up 1.1% week over week and likely to peak next week. We've been tracking all year this phenomenon of immediate sales. Immediate sales are happening when homes are getting listed and they're taking offers and going into contract within hours or days. There's a lot of this tied up with coming soon listings, so that the house is pre-marketed so that There are offers lined up as soon as it gets listed for sale. And so this phenomenon has been a big part of the pandemic. And it seems to have peaked. So when houses get listed, they're now spending slightly more time on the market. I'll show you later when we look at days on market, how it's ticking up just a little bit, still at sort of record low levels for this time of year, but this immediate sales. So what we're going to see here, right now, 22% of the market is still going into contract immediately. Demand is still ultra high. Rates are low. It's still a really, like, if you can afford and you have your down payment, like, it's a good time to get that deal done. And people are very much interested in doing so. But it's going to ease back. And you'll likely see that be maybe 20% next week and start to decline through the end of the year. If it declines quickly down to zero, that will be one of the signals that we're keeping our eye on for, have consumers, like, is there some transition in consumer demand? This is a number we report every week now. And so, like, this is going to be our leading indicator for what is demand, what is happening for demand. Okay, here's another way to look at inventory. So we see the normal seasonal patterns. I've shown you those. We've been lower each year. And so this is looking at year by year inventory. Normally we have our July and mid-August peak. We can have, this is the last 5 years of data. And so last year we can see that the inventory declined through the year. Through this point of the year would normally be climbing, and then third, end of the third quarter and the fourth quarter is normally declining. Each year it declines. So what that shows us for this year is this pattern. We've been ultra low, we're at our peak, and we are likely to finish the year maybe below 300,000 single family homes. It will be, the slope of this decline in the second half of the year is going to be really fascinating to keep our eye on. But there is no, at this point, real impetus for a surge in inventory to reset this higher. So this is the pattern that we're going to look at. We're going to start 2022 ultra low, and maybe if rates climb, you'll see this climb. So in this line here, you can see the yellow line. In 2018, rates climbed, and you can see how they finished the year with more properties on the market. Not a ton more, but fractionally more. Like, that's the window we have, is can we go from 400,000 to 450,000? But as of right now, we're looking to end the year probably under 300,000 homes on the market. And it's going to be this shortage. It's going to take several years. It would take several years of notably higher interest rates to reset that number higher. There are some properties still in the mortgage forbearance process, and that mortgage foreclosure process is in flux. Almost all of those people have increasing equity. They have opportunities to refinance at ultra low rates. So there's going to be essentially none of those properties that hit the market to increase our inventory, that in distressed inventory. So don't look for any surge in inventory. There's no signs of it. We've been looking at it every week for 18 months now, and they're just not coming to market. Okay. All right, let's move on. As we go through this, what we're looking at here is U.S. national data. And at the end, we're going to dive into the local data in some of the local markets to take a look and see how the local things are changing, behaving differently. All right, let's switch from inventory supply into prices. Current median home price in the U.S. is $394,000, $394,900. That ticked down $100 from last week. And this is the dark line on this chart here. You can see that we are at the time of year when prices would normally be pulling back, and you can see previous cycles, previous years, The peak is usually June 30th, and we pull back. Last year, prices stayed elevated really all the way until November, as people were buying way more than expected in the winter months. This year, prices have stayed elevated longer into the summer, really a month, 6 weeks longer. They are starting to tick down now. And so like that's the seasonality that we're trying to get in. And what's happening is, homes get listed for sale in June, they get offers in July, and they close in August. If they list in August, now there are fewer buyers, so they start taking price cuts, or they have to list a little bit lower. If you bring your house to market at the end of October, you need to price it a little bit lower to make sure it moves before the holidays. That's the phenomenon you see in this seasonal pattern here. What we've seen, though, is because demand's been so strong this year, you could continue to price strong late into August. But that's starting to try to get back to normal. And then next year, we'll see likely a much more normal seasonal pattern, which means we'll peak June 30th and then prices start declining. We are at a 12% year over year price gain. If you're looking at the headlines now, the headlines now are typically reporting sold data that happened in May or June. And May or June is what's been reported right now. So you'll see the headlines still saying that home prices are up 17%, 15%, 19%, depending on which number you're looking at. And if you look at this chart here, those sales, those closed sales are backward looking. They're old numbers, and they're pointing it right at this peak of the number. And I'll show you another way to look at this over time. The light line here is our leading indicator. It's the median price of the newly listed cohort. And so what happens is each week, the prices get listed for sale, the houses get listed for sale, and the listing agents, the sellers, know exactly how much demand is out there. They know how many overbids were down the street. They know how many shoppers were at the open house. And they price the new listings accordingly. So we can use the new listing number as a leading indicator for where transactions will take place in months down the road. So the light line here has showed us a little bit of volatility this summer, and just now starting to decline. Last year, you can see it stayed elevated all the way through into November. So what this is telling us is that we have several more months of very high transaction prices to report, but not quite as strong as last year was, like the crazy countercyclical strong. So we could see the normal seasonality. We'll reset this January. Each January will reset, and it will look like we'll be at about 12% annual gains, which is a big year, but we're not going to finish the year at 20% gains or 18%, which is some of the headlines now. The price acceleration, price gains have been slowing the second half of the year. So I like to point this out because as professionals, there's a lot of different sources in the headlines, and you'll see some that say, oh, the market's cooling, and then you'll see another one in the same publication that says home prices are at record gain. What you can see is big year, not as high as the gains from March, April, May, and much more normal seasonal. So the seasonality is really what the story is right now. Here's a way to look at that on the normal seasonal cycles. This is a pattern of price gains, annual gains, year-over-year gains at any given point. You can see normally in the last few years, we've had strong years, 5, 7, 8, 6% annual price gains. 2018, interest rates started climbing, and so the annual gains were lower. We rolled into 2019. 2020 was strong. We had 3 weeks of pandemic price bargains where we had year-over-year prices decline. This is this little dip right here, April of last year. And then boom, the rocket started taking off. And as the rocket started taking off, price gains all the way through the year. And the biggest peak of the year was March, April, May of 2021. And so right now we're seeing headlines that are reporting gains from this point, this 18% price gains. But the real-time data that we're looking at here shows us that that's decelerating. The craziness is backed off. And so we're at our 12% annual gains. And this is likely where we're going to settle in for the rest of the year, somewhere around this 12% annual gains. And so don't be fooled by the headlines. And also don't be fooled by a story of decline. Like we're declining into a really strong gain year. Okay. When we talk about leading indicators, one of the most powerful leading indicators of where transaction prices will be in the future is this measure that we use. It's the percentage of homes on the market taking price reductions. The way it works is this. Homes are on the market now, and they've been moving very quickly. If your house doesn't get an offer in 2-3 weeks, now you start to worry that it's overpriced. And school's starting. The holidays are coming. We probably need to cut our price to get ahead of this market shift, of this time of year. So more and more homes cut their price each week. What we can see is therefore a very strong seasonal pattern. The fewest price cuts are in January. Fresh inventory is coming onto the market. If they haven't sold by March, if they were listed in January, they haven't sold by March, now we start to cut prices a little bit. Then by April, May, June, if now we list the properties and they haven't sold by the end of summer, we start cutting prices. You can see a few things. One is this normal band. Normal means that about a third of the homes on the market take a price cut before they sell. Sometimes it's strategic overpricing, sometimes it's accidental, sometimes it's a crazy seller. Whatever the reason, is about a third. This can vary locally. So in the hot California markets, it's very often closer to 20%. In some of the markets that have stronger inventory available, like for example, Phoenix or Dallas, this might be normal, might be more like 40% or 42%. But in any case, you have this seasonal pattern. Think of it as 35% is normal. When markets cool, then more homes have to take their price cut. And when they take their price cut, then this climbs to 35, 40%. When markets are hot, fewer homes take the price cut. And so 20%, even though 35% are overpriced, only 25% had to take a cut because the buyers were there. You can see in 2018, interest rates were climbing and therefore price reductions had to climb. Fewer buyers. 2019 started the year with more price reductions because of that higher interest rates. Then interest rates started falling in 2019 and the market reset. For 2020, in 2020, we had the pandemic reset things and then demand accelerated. So all of our seasonality evaporated in the last year. We had none of the seasonal price decreases that normally would happen around the holidays because people were buying homes around the holidays. Then January started, it reset. So here's some seasonality. We see normal season price reductions are climbing. We've got a few more months of price reductions to climb as there'll be fewer home buyers in November and December. And we can actually see it in a few local markets right now, people who were like, they were nuts. And so sellers were saying, well, let's see how much we can overprice. And some of them were overpriced. They got to take the price cut. So I'm going to show you a couple of those in the local markets now. What this is showing, though, is we're likely going to reset. We're going to hit our peak of maybe 27, 28% in the fall. Still going to peak in a hot market, but in a normal seasonal pattern. We may be resetting an entirely new low. We have fewer homes on the market, we have lower resetting with lower inventory as a normal set. So right now, 24% of 25% of the homes have had price reductions. It's climbing each week. That's healthy because that means that things aren't getting even crazier, but it's still resetting. It's a hot market. You can see that demand is out there. That means that there's price support for sales, price gains well down the road. House is on the market now, it takes a price cut next month. It gets an offer in October, it closes in November. So the sales numbers are what you start seeing in December. You can see the data right now in the active market. Let's look at the flip side of that. Sometimes homes are on the market, they come off the market, they get bought or they get pulled, and then they get relisted at a higher price. When investors are doing flips, they relist at a higher price. Normally, 2-3% of the market is in this case. This is nationally. Last year, stuff got pulled in April, and then all of a sudden demand is out there like, hey, let's try to relist. Let's relist at a higher price. And so all of a sudden, 4.5-5% of the homes were getting listed. By this spring, everybody knew the frenzy was on. Their flips were happening high. And so we peaked 7.5% of the homes on the market in March had been listed recently at a lower price. Like the flips were on, the investors were on, the iBuyers were buying and relisting it at a higher price. All of those things were peaking. That peaked in March. And so now we're back down to a much more healthy level, 4%, still hot market because there's still a lot of folks who are in these rapidly appreciating markets or buying, do a quick remodel and flip, but much more seasonally normal. That's going to keep declining through the holidays to reset for first quarter of next year. This is one of the ones that I've been looking at all year to know the bubble question. You know, are we in a bubble? And one of the things that happens when we're in a bubble is that you get investors feeding into that, buying, flipping as quick as they can, because those speculators aren't getting as rapid a return. There's fewer of them taking that action, and it's a much more healthy signal for the market than it was in March of this year. Here's one more way to look at this action of homes that are on the market, they come off and they get relisted. When it's a pure relist, and by that I mean homes get withdrawn and then relisted, and it happens all the time. It happens for all kinds of reasons. Relisting is if buyers start getting cold feet, if contracts start falling through, if appraisals can't happen, they don't, and the house has to get relisted. Those are all very bearish signals for the market. Those are cooling signals for the market. And so the relist percent would start climbing. As you can see right now, we're at 1.5% of homes have been relisted. Like it's totally a normal rate. You can see an annual reset. So houses get pulled over the holidays, they get relisted in January. So each year we have this spike in January of relist. And actually this January, because demand was so high through the holidays, a lot fewer homes needed to be relisted. So that was a real low January spike for us this year. What we can see here is normal seasonal patterns. If you are concerned about a bubble bursting, about consumer demand falling through, there's definitely a lot of folks who have this hypothesis about like, the American consumer cannot support and continually rising prices. If you are in that camp, relist percent is one of the numbers to keep your eye on. And you can keep your eye on it in the Altos data every week. That relist percent right now is 1.5%. Like I said, it will spike after the holidays because homes get withdrawn and then relisted. But if they start climbing, for example, if it starts climbing in March of next year, February next year, or even later in the fall this year, that is a signal that you can look to verify your bearish hypothesis. So if you're on the call and you're one of those folks who have a bearish view of the American consumer's ability to pay, this is a number I recommend you keep your eye on. For me, I'm looking at it right now, and we see no signals of the consumer backing out. So it's one thing one signal that you don't get elsewhere. If you're familiar with the Altos research data, you'll know that we have an indicator we call the market action index. This number is all the supply number stuff that we've been talking about relative to the demand. So supply could increase, but if transaction numbers are very high, this number is still going to go up. If supply increases and demand starts to fall, this number starts to fall. It works like a speedometer. 30 is a balanced market. We've been in seller's market conditions for a bunch of years now as the economy's been strong, as rates have been falling. All of those conditions have kept us in seller's market conditions. Like I showed you how our inventory keeps declining year over year. So this year, the pandemic year, we've been in record territory for the market action index, record strong sellers conditions, where in the 60s, where 30 is a balanced market, below 30 is buyer's conditions. Like the market took off in last year, was 50 last year this time. This spring was ultra high. We talked about all the indicators showing the frenzy, and the market action index is no different. We normally hit this peak in June so that it starts declining. And you can see that we have had our demand peak for the summer. We are stabilizing in very high conditions. So it's yet another indicator that the seasonality is coming back, but it's still really hot. So ticking down month over month, and should continue to tick down into the rest of the third quarter and the fourth quarter to reset for the spring. That's what we're looking like at the market action index. In your local data, when you look at your local Altos reports, when you're taking your reports to your clients, the very simple indicator is to say, look, there's a lot of data here, but I want you to look at one number. I want you to keep your eye on the market action index. If this number starts to fall out of the strong sellers market into sellers or even closer to a balanced market, that's the market telling us that demand is backing off, supply is increasing. And this is important when we have your house listed for sale. That might mean, for example, we need to get ahead of it and price a little bit lower or cut the price. Or if you're a buyer, this may mean that we have opportunities opening up and in front of us to get into our buying mode and start shopping. So while we're in the market, I'm going to put this report in your inbox every Monday, and I want you to look at this one number. Use the market index for that. And I'll show you a little bit of that in some of the local reports in just a minute. Now, on the demand side, one last indicator on the demand side that, of course, we like to keep our eye on is days on market. So, we've been in record low market time all year. You can see we normally hit the bottom of the market time at the end of June, and things start ticking up. Normally, it's 8 weeks, 9 weeks for the national market, like 9 weeks on the market. As the year gets older, you might have 6 months on the market before homes sell. This year we hit record low 21 days, median days on market. We're at 28 days right now. And so super low, and likely start to tick up, like we said, in the fall. So you can see the seasonal pattern starting. You can see last year we had no seasonal pattern. Like, it was still falling this time of year. It kept falling into October, November last year. But so we're resuming our old normal seasonal patterns, just lower, just hotter than we were. And that's what we're looking at on the demand side. One of the things we're going to do today, and one of the things that I recommend we do with all of our home buyers and sellers, is to use price ranges in the conversation. Now, all the data I've been using so far has been national data, all the homes, every home on the market. What are the pricing? What are the changes in pricing? But we can look at price ranges, and the high end of the market may be behaving very differently from the low end. So what Altos does is in every zip code in the country, we break every geography into 4 price range quartiles. In the US, the high end of the market, these are $1 million homes. The low end of the market is only 150,000. And we can see what that means, what kind of home we're getting for that. Those are smaller lots, 3-bedroom, 1-bath. They're almost 70-year-old homes. The newer homes, the more expensive homes are significantly newer, significantly bigger on significantly bigger lots. We can also see exactly where the demand is. In the middle of the market here, we're still at 21 days. This is still nationally, but these are the price ranges. The low end of the market actually takes a little bit longer because these tend to be like not that nice, right? There's a lot of junk down here in this low end of the market, a little bit longer, 28 days. And 42 days at the top of the market is still super crazy fast. But when you're spending $1 million, it is much more meaningful to keep it it takes a little bit longer to sell. So we're also going to show, I'd like to spend a little bit of time in the local markets, looking at the price range segment. The absorbed in this case, in this column, these are the ones that are going into contract. It's before they are sold. So it's the fastest proxy for sales. So it goes into contract, or sometimes it gets withdrawn and you don't know that it's not in contract yet. So we call it absorbed, and those will sometimes get relisted. So you can see them on the relist side. But in this case, you can see exactly where the demand is. We call it absorbed because they're not sold yet. They're no longer available on the market. So you can see that where the demand happens, exactly where the price points are, where the transaction volume is happening. And then let's finish up the slides with interest rates today. Then we'll switch over and look at a few local markets. The biggest story, of course, is interest rates have been falling for 2 years. They did a little bit of climb in January and February, but they've been falling again since the middle of February. They've been falling for months. We're down at 2.8%. The long-term average is 4%. And so at some point we should expect interest rates to rise. I say that I bought my first home in 1996, and I had an 8% something interest rate, and I locked in at 30 years fixed rate because I expected rates were going to climb. And then I bought my second home in 2001, and I locked in at 6.5% because I expected rates were going to climb. And so then I bought my third home, and every time I keep expecting rates to climb. I have no ability, it turns out, to predict where interest rates are going to be, where they're going to go. But what I do know is what happens when they do climb. We can see this period in 2018 where interest rates climbed above their long-term average, and it had a marked impact on demand. It was this time, if you look at our inventory chart, this is the only time that inventory climbed year over year. Inventory has been declining for a decade because Americans are becoming more and more landlords. They're buying and owning more second homes for rental income. And so inventory, fewer and fewer homes are available on the market at any given time. That's accelerated this year as rates plummeted. We bought even more of those. And so there's even fewer homes on the market right now. So what's unclear is if rates climb from 2.8 to 3%, 3.8%, does does that slow stuff down even though it's below this long-term average, or does it have to go above 4 before we really see a slowdown in home prices? But what is clear is that like we're so far below that normal that 4%. Everyone in the country has their mortgage locked in low, so no one is going to be forced to sell because of rising costs, because we're locked in at super low rates. That really is an indicator that our inventory is going to be locked in these lower levels for many years to come. There's no indicator of that we're going to have to sell. Like nobody has to sell to because the rates are low and rents are high. Like these are really good investment properties. If rates climb, let's say they climb to 4% or above 4%. If they do that for multiple years, then now when people go to buy the next house, they'll be forced to sell the first one, and some more inventory will come to market. It would take several years of that to reset to higher rates. Higher rates to reset our inventory at higher levels. So you should expect over the next few years, that at least the next few visible years, that we're going to have our record low inventory stay locked in. Significantly fewer homes than were for sale even 5 years ago. Okay, that is the slides for right now. And let's switch over to looking at some local markets. And share my screen here. Let's start with the Seattle area. Seattle, and this is looking at King County. Seattle has been arguably the hottest market in terms of buyers and demand for the year and low supply. You can see our market action index is still slammed at 100. The inventory has been low, has risen a little bit, but not dramatically. And you can see here, so, just a few years ago, you might have had 4,000 homes on the market, and we're at 1,400 today. So the Seattle area still seems to be the hottest in the market. You can also see it when we look at the price ranges, where low-end Seattle, our days on market is still 0. And if you attended these webinars in past months, you could see we would see 0 days on market, essentially everything selling immediately in a lot of places around the country. Right now, there's significantly fewer places, but Seattle is one of the places. And really what's fascinating is, anything under $1 million is going in 14 days. And I think under 2 million, still 3 weeks. Like the demand in Seattle is still remarkably strong as we go into the fall. Here's one though has been changing perhaps. We can see, so Boise had a ton of California immigration all year, driving prices way up. Boise and Austin, I have some Austin here as well. But here's what's fascinating. Boise, you can look at the market action index, big decline in a month. So still nuts, crazy hot. And this is the number that caught my eye though. This is the percentage of homes on the market with price reductions. Remember, this is the one that is a leading indicator. It talks about demand. It helps us know where price reductions are going to be in the future, or where transaction prices are going to be in the future. And you can see Boise's normal pattern. Boise is 40%, 25, 40. And then all of a sudden this year, massive, especially California immigration, price reductions were 4.5% in Boise. And this is peak of the frenzy, lots of overbidding. And then what happened was sellers in Boise said, I'll take that. And they started overpricing as much as they could. And what we're seeing now is price reductions have risen to over 40% in the Boise market. That is really showing us that the peak of the frenzy is past in Boise. We're trying to get back to normal. Prices are still way up. Demand is still very strong. But if you are a jerk and you overprice your home in Boise, it's not going to move. It's going to take, it's going to require a price reduction before it moves. I thought that was a really fascinating change that we're seeing late summer in Boise, moving out of maybe the hottest market in the country to something a little more sane. In the price ranges, you can still see things are still moving. Anything under $500,000 is still moving super fast. Anything under $1 million is still moving super fast. But that price reductions was a very powerful indicator of like some sanity coming back into the Boise market. I had Loudoun County, Virginia open. We were looking at a few things. Loudoun County was another one of these places that had a real strong year. You can see Loudoun has some real high-end, big acreage properties. And the fascinating stuff here is, that's 90 days. That is, several months, 6 months, 7 months to sell, where anything under that is moving in just a couple of weeks. So I was thinking about that as a really powerful indicator in Loudoun. Still had big year-over-year price increases, and still holding strong. Like compare that to Boise, the demand levels in Loudoun haven't really declined in the last month. I'm going to look at Gwinnett and then Austin, Texas. So Gwinnett County, Georgia has had this strong year of price appreciation, big inbound. You can see in the market action index ticking down just a little bit month over month. So starting to normalize just a little bit, but as inventory climbs, so we can see more inventory coming on the market. But look, we're still in these, anything under $1 million, anything under $500,000 is moving super fast. You can see exactly where the demand is, and a big price appreciation year for Gwinnett County, Georgia. Finally, Austin. Austin is one of those that had the biggest price appreciation years, just massive spikes, especially with California immigration coming in. You can see a little bit of seasonal decline in the market action index. So starting to get a little bit of normalcy. And here's the price decreases line for Austin. You can see our normal years, Austin 20s with a peak at 40 or 50%. That would be normal. Last year, all of a sudden we're down at 6%. And we're getting back up into the 30s in Austin. So not quite as dramatic as the changes in Boise, but a little bit of normalcy starting to return to the Austin market. So those are the fast local markets for the week. Thank you as always for attending. We get to this stage of the conversation, and I'm sure there's a lot of people in the chat who are saying, can you look at my local market? And so the answer is yes. The best way to go to the local market data is go to altosresearch.com and book a demo with our team. So we'll show you the local data, what's happening in your local market, and how to use that data in your conversation with your clients. Like if you have that market, that ebook, you can use that and find the scripts and do the conversation, but book time with our team and we'll walk through that with you. Market data is how we help our clients through this fear, this uncertainty. There's headlines saying record prices and market cooling on the same publication. Like the data is how we are going to be most clear, most powerful with our clients. The market is changing and people need you to be able to see clearly. So Thank you for being with us today. As always, more next week, and we'll look forward to working with you soon.